going, it may influence the Fed. That tells you the state of things, doesn't it? I think it's just kind of funny.
It would be a big mistake if this crisis reduced the amount of tightening we need to control inflation. I think the Fed rate hikes is 10 times as important as what's going on in Russia right now.
You're doing it too. You're doing it too. I mean, obviously, Ukraine is far away, but the kind of toll that we're talking about, if it were to be the worst case scenario and the human suffering and everything else, it's just, don't you think it's kind of ironic that we reduce it to what Jay Powell's going to do here in this country?
Well, Jay Powell has to look at everything. But, think back, Joe, you remember the 1970s when oil prices were going up and the Fed was not tightened enough and inflation raged for a decade. And it wasn't until Volcker finally said enough of it and, had to raise the Fed funds rate to 20%. We don't want that to happen. You got to act against the inflationary pressures from wherever they come. Now, fortunately, it looks, at least at this point, oil is $2 or $3 on what is going on in the Ukraine. But let's face it, oil was heading up way before the Ukraine crisis, and many experts called for $100 oil before the Ukraine crisis. So that just adds fuel to the fire. He has to look at everything. It would be a mistake for him to say, oh, yeah, there may be trouble there. As a result, we'll delay in tightening. There has just been way too much money growth and stimulation, and Fed is way behind the curve. So way behind the curve at acting against it.
You do see some similarities to that period of hyperinflation then, because most people do not, because it's a supply chain and it's sort of a coincidence that oil happens to be spiking as well. But there were many other things back in the 70s and early 80s with we're seeing some wage pressure too. So you see enough similarities to think that this elixir or this combination of things could result in something really troublesome. If so, it's pretty bizarre where rates are right now, because I mean, even back then they started at 7 or 8, didn't they, before they went to 20? I mean, we're starting from, we're basically starting from almost zero globally.
Yeah. I've mentioned before that the long-term Treasury has been a wonderful hedge asset against short-term stock market risks. It has an enormous what's called hedge demand, which it never had in the 60s and 70s. In the 60s and 70s, Treasury bonds were terrible hedge assets because oil spiked up and inflation and the Dow went down. They were not good. Today, if anything crisis happens, the Dow goes down 2,000 points, people rush to treasuries. And as a result, that keeps that long-term Treasury low. It is deceptive to say that there's no inflation just because the Treasury rate's 190. Again, I'm not saying we're in the 70s. No, we had in the 1970s, we had 10% inflation. We had, for almost a decade. We're not there yet, but I don't want to get there. And I don't see the Fed slowing down credit growth in particular. You've mentioned the M2 growth, which, by the way, comes out this afternoon. People don't watch that indicator. It's the fourth Tuesday of every month. And it's been out of control. It's been 40% increase since COVID-1. And even after the original crisis, it's been going up at double-digit rates, which is way too much to be consistent with any notion of price stability. That has to be put under control. And the only reason is both reducing the balance sheet and raising rates.
Jeremy, I don't think anyone at this point really ascribes the really hot inflation numbers that we're seeing to what you're describing. And that is what hawks, monetary hawks, always talk about, and bond vigilantes and but it's been so long. But you really think that the Fed has printed so much money in the past 5 years, you think we're seeing that in some of these inflation numbers now? You think that things are coming home to roost? There's already, it's not supply chain, it's not COVID, people not wanting more money to come back, and the great resignation and all this other stuff. You think there's a direct correlation between M2 growth and inflation, because that's going to be much harder to put back in the bottle.
Exactly. But the M2 growth was stable until the pandemic. It was growing actually at 5 to 5.5% a year for 34 years until the pandemic. Remember, even the quantitative easing that Bernanke engaged in never pushed into money. It just pushed into reserves. But this COVID pandemic, totally different. All the money creation pushed right into that M2, which is so much more potent than the reserves. That's where, if you take a look at M2 graphs, you're just absolutely astounded. In the year 2021, we had the greatest M2 growth in 150 years. And that is what is the reason why, as you know, from the very beginning, from 2020, I was saying we're going to have an inflation problem. Goldman Sachs talking about 7, 8, 9 increase. I think it's got to be at least 2% by the end of the year, and perhaps even higher than 2% at the end of the year to begin to control monetary growth. Doesn't mean that the long rate's going to go up all that much. I think we will end up with an inverted curve, very honestly, short and long. It doesn't necessarily mean a recession yet, but if we don't start right away, the tightening will have to be strong enough that it will produce a strong slowdown.
Would you tell policymakers to hold off on big fiscal spending as well, or is your 90% of what you're talking about is with monetary?
It's 90% is money, and I think, given where Manchin and others stand and that inflation, I don't think there's going to be a lot of expansion over the next 12 months. I'm looking at the Fed to finally say, hey, we've been wrong, we've been behind the curve, but we are now going to get serious, and there's going to be a little bit of pain, but the longer term looks good. And don't forget, stocks are real assets that will survive inflation. They just have to survive the interest rate bumps that are needed to get that inflation under control.
All right, Jeremy, thanks. We started with, I don't even think you said Ukraine. You might have just put it, but it was in the, just looking at what happens in monetary policy based on what happens geopolitically, which is what I was kind of kidding about everybody else, but you fell right into that, and I think you're probably right, because these things in the past have not been long lasting, but someday maybe it will be. The world can only end once, thank God. Professor Siegel. All right, see you later.
Thank you, Joe.
Okay.